The Dodd-Frank Wall Street reform law that was signed last summer requires more oversight of so-called too-big-to-fail banks. But according to a new Bloomberg government study, the largest U.S. banks have only grown larger since the financial crisis. And the number of these banks is set to increase 40% over the next 15 years. Our next guest says it's not size that matters, it's capitalization. Dan Alpert is a partner at Westwood Capital. He's also their key analyst for banking and financial reform. Dan, thanks for joining us.
Good to be here.
It's funny, you know, these banks that were too big to fail, we've all seen the takeovers. Bank America, Countrywide, Merrill Lynch is one gigantic bank now. I mean, they got bigger and bigger and bigger after they were rescued by TARP.
Well, they certainly did, and obviously part of that was due to a bunch of shotgun weddings that were set off by the regulators. But, you know, you can't really look to too big to fail. It's an often used phrase. It was a very good book by a good friend of mine, Andrew Ross Sorkin. But I have to tell you something. The issue is not capitalized well enough, not too big to fail. And the issue that the regulators should be advancing really is capitalized to ensure survival.
Although they are bigger and bigger and bigger. They're systemically more linked to everything else in America. They aren't going to be allowed to fail, obviously, at this size, regardless of their capitalization.
And because of that, the issue of capital becomes even more important. I mean, let's look at Canada, for example. I mean, Canada has four major banks, right? Five if you count.
They didn't get into trouble,
right?
did
They didn't get into trouble. They have exceptionally conservative laws with respect to mortgage lending, and the banking system there is really, if you actually look through the world, it's the healthiest in the developed nations by far. And I'm not Canadian.
So let me ask you, so if the key is capitalization, I get it. Basically, banks take all the risk you want, but make sure you're well capitalized to cover those risks. Where are we in terms of capitalization for the U.S. banks?
Yeah, let me just correct something. It's not take all the risk you want. In fact, let's watch the risk you're taking.
Okay.
Be sufficiently capitalized in order to avoid unforeseen black swan type of events.
And that's basically my point.
And that's really the issue. But more important than that, it's also looking at the banks from the standpoint of saying, you know what? We are never going to get back to a point in time where a major banking institution in this country is not systemically critical. And to the extent you're systemically critical, this is what I've been advocating now since the crisis. We need dynamic capitalization for banks, meaning the larger you are, the more conservatively capitalized you need to be.
But in terms of lawmakers, they're not even thinking, I mean, where are we in that process? Is that just totally off the radar? And
well, look at the other big story today, which is the story of bank dividends, right?
So they're giving out cash.
The Fed announced, hey, you know, we've seen the 19 largest banks that were the subject of the SCAP, the stress tests, gain $300 billion in additional capital. And that sounds great. But in fact, it's not far off what they originally thought their pre-provision net revenues would be as a result of looking forward in 2009 and 2010. The problem, of course, is the SCAP also projected about $600 billion in losses, which didn't happen. We had a fraction of that actually happen. And the reason is that in a whole variety of asset classes, we've successfully kicked the can down the road. So while the Fed is out there saying, you know, we'd like these banks to have access to the capital markets because that's good for all of us. They can raise capital. Their stock's worth a little bit more. Their shareholders won't complain about dilution as much. The problem is going forward that if we don't have really tough capital rules for these banks, we may find ourselves in another situation when some of these losses that weren't recognized ultimately percolate.
So what you're basically saying is the idea that we can somehow make banks no longer too big to fail is silly. We need to move on and just regulate them better because they are, in fact, too big to fail and only getting bigger.
They absolutely are too big to fail. And look, there is a credible argument for folks that want to slice and dice the banks and want to go back to Glass-Steagall and reverse the course of history. And I'm not really, you know, time marches on kind of guy. I recognize the fact that the one argument that actually prevailed in the 1990s with regard to the dismantling of Glass-Steagall, you know, forget about all the lack of regulatory oversight, which was certainly a problem, but the actual dismantling of Glass-Steagall was a rather sound argument, and that is every other nation in the world has banks that do things across the spectrum of financial services. So how do we compete with them? It's one thing when we're a country rather cut off with two oceans from the rest of the world, but in the new global world, it's very, very difficult to do otherwise.
All right, hey, Dan, thanks so much for joining us. Dan Alpert. We